Welcome to the Foundry by Forge College. Grab your hard hats and slide rules, because today we are unrolling the architectural blueprints for the future of money. In this explainer, we're going to unpack financial and payments use cases together.
Let's start with a sinking feeling I think we all know entirely too well. You send a standard bank transfer on a Friday afternoon, and then, well, you wait. You're just left staring at your screen asking this exact question: where exactly is my money right now? You wait days for it to clear, kind of wondering if those funds just floated off into some digital void. It's stressful, it's slow, and honestly, it's a bit outdated.
So here's our architectural blueprint for this explainer. 1. The blueprint of blockchain finance. 2. Propagation, settlement, and trust. 3. Throughput versus latency trade-offs. 4. Real-world payment flows. 5. Simulating settlement delay. And 6. Practical integration steps. We're going to build a clear bridge from abstract theory right down to everyday financial realities.
All right, Section 1. The blueprint of blockchain finance from theory to operational reality. If you were with us for the previous blockchain applications overview lesson, you are in great shape because we're building directly on that foundation today.
Look, the core truth here is that blockchains, they aren't magic. They don't just sprinkle digital fairy dust on the financial system. What they actually do is enforce predictable settlement rules and provide a tamper-resistant, auditable trail. And really, that's it. It's simply a highly engineered set of trade-offs designed to simplify reconciliation and shift our reliance away from slow, centralized intermediaries and onto verifiable cryptography.
Moving right along to Section 2, propagation, settlement, and trust. These are the core mechanics dictating your operational risk. Think of these as the three mechanical, load-bearing pillars of our system design. They determine exactly how fast the network sees a transaction and how likely it is to actually be finalized.
First up, we've got propagation. This is the network-level process that determines when different nodes across the world actually see a transaction. I always like to compare propagation to spreading a really juicy piece of gossip at a party. It is not instantaneous. One person tells 2 people, they tell 4 people, and so on. In a financial network, that speed of gossip directly impacts when a merchant or an exchange can finally see and act on your payment.
Next, we have finality. This is the absolute guarantee that a ledger entry will not be reverted and is treated as authoritative. So, the crucial point here is that finality is the moment the ink truly dries on a contract. It's that exact beautiful second when the money is officially yours and absolutely nobody can hit the undo button.
And this brilliantly illustrates the two types of finality we have to choose between. We have probabilistic finality, which means waiting for a certain number of block confirmations, versus deterministic finality, which is a definitive consensus message. Think of probabilistic finality like being out to dinner with a notoriously cheap friend. The longer they sit there staring at the bill, the more probable it becomes that they'll actually pay, but you're never 100% sure until they do. Deterministic finality, that's them just handing you the cash. Immediate, done, absolutely no takebacks.
Which leads us right into Section 3, throughput versus latency trade-offs. Balancing system speed and transaction capacity. In system design, just like in life, you simply can't have everything. You have to explicitly choose. Do you want lightning-fast single payments or massive, slower batches of thousands of transactions? When we map these software mechanisms onto real-world financial implications, the trade-offs become really clear. Propagation, which is managed by gossip and mempools, actively controls visibility and front-running risk. Finality, whether probabilistic or deterministic, dictates your settlement rules and liquidity buffers. And throughput versus latency directly impacts the end customer experience.
All right, enough theory. Section 4, real-world payment flows. Taking our blueprint out into the field. It's time for a little field trip to see how these exact mechanics play out across 3 very different environments: retail, wholesale, and remittances.
First, retail point of sale. Imagine buying a coffee. This demands low latency. Waiting 10 whole minutes at the counter for your latte transaction to probabilistically finalize on a main blockchain is, well, it's a terrible user experience. You'd hold up the whole line. This is exactly why retail flows often require instant payment channels or Layer 2 solutions built off the main chain to get that sub-second speed.
Now contrast that coffee purchase with interbank wholesale settlement. Here, clearing billions of dollars requires deterministic finality and high throughput.
Banks settling massive netted positions at the end of the day care way more about absolute certainty and batching huge sums together than they do about sub-second speed. They'll often utilize private permission ledgers to get that deterministic guarantee.
Finally, cross-border remittances. Sending money home focuses heavily on trust minimization. A blockchain design cuts out the slow, costly correspondent banking middlemen in international transfers. However, we still have to convert fiat currency to tokens at the on and off ramps, and that introduces real operational friction that our engineers have to carefully design around.
So to summarize our technical focus by use case, retail is all about latency, wholesale focuses on throughput, and remittances prioritize trust minimization. Each of these financial flows balances our core blockchain trade-offs differently, based entirely on their unique operational needs. Moving along to Section 5, Simulating Settlement Delay. Demystifying the Python settlement model. Let's translate these abstract concepts into measurable, quantitative code. And hey, don't let the idea of code intimidate you. The engineering steps for a Python simulator are highly logical. Step 1, calculate the propagation latency, or exactly when the transaction was first seen. Step 2, wait for it to be included in a block. Step 3, count up the required confirmations. And Step 4, check for reorganization, or reorg, events. We literally just wait for the network gossip spread, stack the blocks, and make sure the chain hasn't been rewritten. It's highly logical and highly measurable.
Which brings us to our final phase, Section 6, Practical Integration Steps, merging on-chain magic with off-chain reality. Because to get all these amazing blockchain benefits, you actually have to successfully wire it into traditional finance systems.
A proper integration checklist requires a few critical steps. You have to build secure on- and off-ramps for fiat conversion. You need to establish strict legal custody arrangements, standardize identifiers across platforms, and ensure consistent metadata for day-end reconciliation. Simplifying reconciliation just isn't automatic. It requires deliberate, thoughtful integration of APIs and accounting mappings. And by the way, diving deep into these exact kinds of operational integrations is a key part of the learning paths available over at Forge College.
So, the pragmatist journey really boils down to this one idea. Translate technical guarantees into operational thresholds. You must always quantify your residual risk and establish strict, clear settlement rules before you deploy any system out into the real world.
I want to leave you with a provocative question to think about. Where could a canonical on-chain record eliminate manual reconciliation steps in your organization? Think about the paperwork, the delays, the mismatched ledgers you deal with right now. How could these blueprints change your reality? Thank you so much for joining me for this explainer. If you want to master more of these Web3 concepts, be sure to visit forge.college to continue your learning journey. Keep building, and I'll see you next time.